the time is 1:05. So shall we start? Okay.
Yes.
All right. So happy Wednesday. Thank you for joining our virtual event, Hump Day Wednesday. My name is Hiroko Nishikawa-Noman. I'm a president of the Women's Council of Realtors, LA-Beverly Hills Network. Today, we have about over 50 people. So some people are joining from California, some people are other states. We really appreciate your time to spend with us. Hump Day Wednesday is our signature event, and we are planning to host this event almost every other week this year with many great speakers. So today we have a guest speaker who is an incredible tax consultant, and he's very knowledgeable, especially for realtors and independent contractor like us. So I'm sure he will give us many tips for tax saving. So we're gonna introduce shortly. So today we have an educational session first, and the last part we're gonna do the networking session in the breakout room. So please stay until the end of this session. So we're gonna talk each other at that time. Before the session, I'd like to introduce our network a little bit. So we are a local network of LA-Beverly Hills of the Women's Council of Realtors. Here are the photo of the 2022 governing board member. I'm a Hiroko, president, and here's a Cindy Wu, president.
Hi, everyone.
Here is treasurer Tony English. She's also an immediate past president 2021. And first vice president is Ann Yue. She's not here today, but another person is a director of membership, Marissa Fletcher. She's here. Okay, and then the director of program, Mary Perdomo. She's here too.
Good afternoon, everybody.
Okay, and we have a committee member, Kanika Kim. She's helping us a lot. And Jacqueline, hi. And then Jacqueline Lemodo is also the committee member. So, and then we are the network of LA Beverly Hills, but not only for the Beverly Hills, we serve the area, large area from downtown LA toward to the Malibu, including Santa Monica, Beverly Hills, Los Angeles, and then Hollywood, Marina del Rey, Silicon Beach. And we have lots of, if you have any referral or inquiry for the real estate market in this area, please let us know. We can help you, your clients. So, and then if you are not familiar with the Women's Council of Realtors, I prepared this slide. Women's Council of Realtors was created in 1938, over 80 years ago. As you know, National Association of Realtors was created in 1908. So, but for the first 20 years, women were barred admitted from many local realtors associations. Women couldn't join the association, realtor member. So a separate group was created and the women's division was formed at the annual convention in Milwaukee, Wisconsin in November 1938. So that's the beginning of our network association. For many decades, many dedicated members has served a role model. So our vision statement is, we are a network of successful realtors advancing women as business leaders in the industry and in the community we serve. I like very much. So now we have 12,000 members nationwide, more than 250 local states networks. We are one of the local network, and we have many leadership trainings and networking opportunities. We belong to I belong to other organizations, so I can tell that the Women's Council of Realtor has very strong mindset to support each other and then refer to each other. So you may get many referral opportunities if you join networking events and then get involved in your activities. We also have many member benefits like discount for traveling, entertainment, and business, many different services. So you can take advantage of them. Let me introduce event planning for our network. So this is the last year's event in person. We have many networking sessions, this is like a Brazilian.
On a conference call.
And then this is a wind down Thursday. This is another educational session. So we focused in the virtual education event in the first half, and then last half, we started to do the in-person event, several events. For this year, unfortunately, the COVID surged again. So we are planning to host the virtual education event like this Hump Day Wednesday event. So the next event is coming on February 9th regarding the risk management in insurance field. We will invite an insurance consultant, Ms. Pepperfu, with Farmers Insurance, and she will tell us how to avoid your buyers losing their EMD and how to avoid declined insurance. The February 23rd, we will invite an expert of the inspections from La Rocca Inspections. They will tell us how to protect the buyers from many costly issues. We just confirmed the LA County assessors to come to our event on March 9th. So he will tell us about homeowners should know about the property tax. So I think many more are coming up, and then we're gonna introduce you later. In-person event, we will set up after the second quarter. So there is some event we're gonna do top producer panel in May, talent show in July, and then wind down Thursday in August, and so on, so on. So you will, we will send you the invitation of our event by email or network, Facebook. So you can follow Facebook us, and you can Google the Women's Council of Realtors, LA-Beverly Hills. If you're not a member of the Women's Council, please join this network. So this is a QR code, and then we're gonna type you some website link later. So click the join now, and then choose our network. The due is $259 per year. We also looking for volunteers to our committee, marketing promotion committee, membership committee, event committee. If you join or work for the committee, it will take a little bit more time, but if you get involved to our committee, we will get to know each other and your activity will be much more fun. So now I want to introduce our strategic partner, 3 videos. So all the partners support to us all the time, and we cannot make it happen for our events and then any activities without their help. So Kanika will show us the sponsors video. Kanika, please take it away.
Thank you, everyone. And do you see the video I'm sharing?
Okay. Yes, there you go.
We can't hear the sound.
We offer a full range of insurance services like auto home insurance, business insurance, life insurance, and medical insurance. For many years, we have been helping realtors just like you to provide a one-stop insurance shop to their buyers in the state of California. Every case is personalized in real estate business, which makes every home insurance to be unique. As a professional insurance agent, we never apply the same standard for all the homes. Instead, we look into the details of every single home to make sure we provide the best coverage for our customer. Not only help with escrow closing, we also assist realtors with post-escrow service, such as policy renewal reminder, policy annual review, and claim services. If you also work as a property manager for your client's investment property, you will be surprised with our claim services. One thing I have to mention to you that all my team members are multilingual. We speak English, Chinese, and Cantonese in the office. With all the 5 stars customers review, we're looking forward to work with you.
This is the next one.
Hello, my name is Chris Griffin. LaRocca Inspections was founded in 1994 to serve your clients' needs for their home inspections in the greater Los Angeles area. We offer the 4 most common home inspections: the general physical, the sewer line, the mold inspection, and the chimney inspection. If there's an inspection your client desires that we don't offer, we have an extensive list of contractor referrals and inspectors on our website. Go to our website for contractor referrals and get your free copy of our Buyer's and Seller's Guide to Inspections. We are your go-to resource for multiple inspection services and annual property reviews for homeowners. We look forward to working with you in the future. Thank you so much.
And now last sponsor.
Robert Hall & Associates is an award-winning tax consulting firm based in Southern California with a heavy focus on real estate ever since its inception. We've been helping people structure their real estate holdings and optimize write-offs since 1971, and we are very good at what we do. Given our expertise in real estate, we take a much closer and nuanced look than other firms. In light of recent events, it's important to know how to structure your holdings. Our firm is well abreast of the latest asset protection strategies, but we are also well attuned to the recent tax code changes and all the many write-offs that are available, which we do with our full staff of enrolled agents. Many clients say our unique selling proposition at RHA is we provide all the up-to-date real estate tax expertise without you having to engage with a CPA. All at transparent pricing schedules as we charge by the form and not by the hour. Remember, it's not about how much money you make, but rather how much you get to keep. Feel free to give us a call for a complimentary consultation that allows us to take a look at your past couple of years' tax returns to see how much we could have saved you. This consultation is there to make sure you're taking advantage of every possible deduction. Give us a call today for your free consultation and join the ranks of our other satisfied clients, which you can find online with a quick search.
Okay, I'm going to stop our sharing.
Thank you so much, Kanika, to sharing the video. So those are very trustworthy strategic partners. So you can reach out to everybody anytime. Now we're gonna move on to the guest speaker session. So today we have a tax consultant from Robert Hall & Associates. This is a slide.
Okay. Thank you, Madam President Hiroko. I have the pleasure of introducing one of our top supporting strategic partners. And as you know, we can't do events like this without support of companies like Robert Hall & Associates, who happens to have locations nationwide. And I put the link to their website in the chat box. Robert Hall specializing in working with real estate agents and their clients, especially in complex real estate transactions where there could be a hefty tax consequence. So please do have them come out to speak at your networks or at your association, because they also are our association affiliates too. So, and also definitely reach out to them personally. Our featured speaker today from Robert Hall is Tony Watson. He's an enrolled agent, and which is what a sort of enrolled agent is. They're certified by the IRS as a tax specialist. I myself was certified as an enrolled agent, so I really appreciate Tony Watson. Tony focuses on providing personalized financial guidance and tax preparation services to individuals and businesses. As a federal licensed tax practitioner, Tony helps his clients make sound financial decisions and works to ensure all eligible deductions are received when preparing taxes. Should a client need assistance with audits, collections, or appeals, Tony is empowered by the U.S. Department of Treasury to represent taxpayers before all administrative levels of the Internal Revenue Service. In addition to his one-on-one client work, Tony Watson is the keynote speaker for Robert Hall and Associates. Yes, he's here. He has spoken for hundreds of trade organizations throughout the state of California. His dedication to clients and expertise in the field of taxation led him to win the Glendale Reader's Choice Award for the best tax preparer in 2016. All right, Tony. Tony not only works in the real estate industry, but he also works with small businesses, entrepreneur startups, entertainment, healthcare, law enforcement, firefighters, education. So if you have clients in those industries, call Tony. And if you're targeting those specific industries and want to hold home buyer and seller educational webinars, call Tony. So today, he's going to share with us about the power of being incorporated, how you can get tax savings during times of economic uncertainty, like what we're in right now. So he's going to be covering entity selections, is incorporating right for you? How do you pay yourself a reasonable salary? Can I rent back my in-home office? Can I incorporate in a different state to save money? The difference between LLCs and trusts, the changes in the tax codes. So with no further ado, Mr. Tony Watson.
Thank you so much for having me. Really appreciate coming back. I enjoy doing taxes, obviously, but I probably enjoy public speaking more than anything else because I get to educate people about what we do professionally in our industry, and that's help our clients retain wealth and not overspend in taxes on a year-to-year basis. So thank you so much to the association for having me back. Like she had mentioned, the topic today is the power of ink, one of my favorite topics to discuss because much like all of you, not only am I a W-2 earner here at Robert Hall and Associates, but I also own several businesses myself. My wife is self-employed and we have her incorporated. So I very much kind of practice what I preach in my seminars. So this will not only be education from a tax perspective, but a little bit of insight into how tax preparers set themselves up. Because obviously we study the tax code, the Internal Revenue Code, day in and day out, and we have a new tax code on the horizon. So we're still waiting on 2020's tax bill to be finalized, but there will be some future changes. But I think that one thing will stay very similar to years past, and that is the power of the incorporated entity and how it can help and assist self-employed individuals to keep more of the money that they've earned for themselves over the, however many years you've been in business. So, and very much tax savings during times of economic uncertainty. I was joking around with a client this morning. I said, what variant are we on now? Is it like the 6th or 7th COVID variant? And I just read an article this morning that they might have found another variant, but it's not as dangerous as the previous variant. So that is very promising. And we all look forward to having a little bit of light at the end of this very dark tunnel. So we've seen the market shift in different ways. We've seen the real estate market boom. Interest rates had stayed low for so long. So, obviously people were in a buying frenzy. So with all of this new momentum in the real estate field, in small business, how do we structure ourselves in a way where all of this wealth and this money that we've been able to capitalize on within our business, how do we keep most of it and not end up paying it all back to Uncle Sam and the wonderful state of California? So there was a short list of topics that we were going to cover today. and hopefully I can make it as interesting as possible. I find it to be very interesting. Saving money is always an interesting thing for me, but hopefully I can give you a couple pieces of information that you can take out and bring back to your own accountant, or if you want to give Robert Hall and Associates a call, we're more than available and readily available to assist you with filing for the 2021 filing season in 2020. So it was a great introduction. Thank you so much for that. This is going to be my 17th tax season with Robert Hall and Associates. Our firm has been around for 50 years, so I've only been a small percentage of the, but part of this, a small piece of the overall pie here at Robert Hall. But I've learned a lot over the last 17 years. Was able to work through the last recession and see what growth models were being capitalized on. And over the past 17 years, I've really built for myself my own clientele list, a really niche part of my clientele list that works specifically in the real estate industry, both on the realtor side, selling properties for commission income, as well as the long-term and short-term investors. And the tax code very much changes when you move from the sales commission side over to the investment world. So if you dabble in both, I think that you're going to get a lot out of this presentation today. Just in my clientele list alone, I think that I have clients with current property and real estate values and managed property investments well into the $350 to $400 million range. Our firm as a whole, probably well over $1 billion by now. We service around 10,000 tax filings per year, and I'd say that a majority of our clients are real estate professionals and real estate investors. So when you get advice from a tax advisor here at Robert Hall, it's not only us practicing what we preach. We, for the most part, are all real estate investors ourselves, but we also apply the same strategies that we apply on our own tax returns to our clients' returns. So once again, hopefully you'll get a lot of great information out of today's presentation. Like I mentioned, we've been around for 50 years, so you can check us out online, roberthalltaxes.com. We do file taxes in all 50 states. So there is not a state that we cannot assist with filing in. And we do actually have clients in all 50 states, which is, I feel very honored and privileged to be here on behalf of Robert Hall and Associates, and also to say that we do service tax files across the US. We're not just a tax preparation firm. We are pretty much a one-stop shop for all of your financial needs. Obviously, our main practice is tax preparation, but if you are looking to incorporate your business, we can incorporate you in-house. We do internal auditing, financial planning, payroll services, you name it, we service it. So, and we have a very in-depth Rolodex of referrals, a long list of vendors that we use. Obviously, the association has great vendors as well. I'm sure we share a lot of those same vendors actually. So if you're ever looking for a cost segregation specialist or a conservation easement specialist or any, an incorporating attorney that you want to talk to about the legal side of being incorporated, we can set you up with a conversation with all of those professionals as well. So and once again, thanks for everybody for being here. We do offer free 30-minute consultations. So the best way to reach out to us and schedule that free 30-minute consult is to text Robert Hall to the number 72,000. I will remind you about this at the tail end when we open up for a little bit of Q&A, but I don't want to waste any more of your time. I want to jump right into the bread and butter today. So we have a lot of options in the incorporated world. We all probably are very, the most well-known entity we probably all understand is probably the LLC. We've all heard that term before. We've probably seen it on lease agreements or contract agreements of some sort where, most people know what an LLC technically is, but what it does for them tax-wise or how it creates liability protection for them is a whole other different story. People are always second guessing whether it's time to incorporate or not time to incorporate, and which entity is right for you specifically, which entity is going to help reduce income tax, which one isn't, and only going to increase liability protection. So we're going to squash some misconceptions over the next couple minutes here with this slide. Most investors, individuals who purchase property and hold title to long-term investments, will utilize the LLC for greater asset protection. LLCs, one thing I want to leave on the LLC table real quick is that LLCs save you absolutely nothing in income tax. LLCs only provide liability protection. And that's exactly what its name entails, limited liability company. A lot of individuals will say that they are incorporated when in fact they are just set up as an LLC, and they think, well, an LLC files articles of incorporation, which a majority of the US I'd probably would say that is true. When in fact LLCs don't actually file articles of incorporation, they file articles of organization. Now, just the simple difference between articles of organization and articles of incorporation That the difference alone could mean significant legal implications for you as a business owner. For instance, if you tell somebody that you're incorporated and you sign your business's name, but instead of saying LLC, you say Inc. at the end of it, what you're telling that person in that contract is that you own shares of a corporation. When in fact, LLCs do not issue shares because they are not corporations. When you own 100% of an LLC, you own 100% of the business, you own 100% of the liabilities, 100% of the assets, so on and so forth. But you do not own shares of a corporation. And that is the main difference. If you enter into an agreement and you tell somebody that you're a corporation and you're not, you could be in breach of malpractice. And the contract would be null and void at that point. Because you don't own shares of a business. Whereas a C corporation and an S corporation actually are not owned by percent, they are owned by the amount of shares issued to the shareholder. So from a legal perspective, you want to make sure you understand the differences between all three of these entities. I'm not an attorney, so I'm not going to go into the legal aspects today of all three of these things. Even if I might know the answers, that's not my lane. So I'll stay in my lane of tax advising. But the LLC, once again, saves you absolutely nothing in income tax. The C corporation in the income tax world is known as a double tax entity, meaning that whatever profit you make through the C corporation not only pays a corporation tax, which according to the Green Book that Biden's administration is in the midst of passing, could be jumping from 21 to 28%. So you pay that corporate tax as well as a tax on whatever you've paid yourself throughout the year. So in the tax industry, we call it a double taxed entity. It is actually a separately filed entity that really is not connected to you in any way. Even though you might pay yourself a salary out of a C corporation, the only connection between you and the business at that point is that you are an employee of that corporation. But it doesn't connect with you financially on any individual filing level whatsoever. Whereas probably the unicorn of the tax industry in the incorporation world is the combination of liability protection and basically corporate America. And what do we all tend to hate corporate America for? Making all of this money and paying very little tax. So the S corporation, also known as the 1120 subchapter corporation, subchapter S corporation, allows you to have the best of both worlds. It allows you to have great liability protection as an incorporated entity, but all of what are called flow through or pass through benefits on the individual side of things. And if this is confusing right now, I promise you it'll all make sense in the upcoming slides. The subchapter S corporation happens to be the most common entity used in the real estate professional industries, specifically and mainly for realtors. Realtors are self-employed individuals. So every year when you go to file your return, if you are not incorporated, you're used to paying three types of tax. You pay federal income tax, you pay state income tax in whatever state you're filing in, and then you pay this wonderful self-employment tax, which is known as SE tax, self-employment tax. And that is you as a self-employed business owner contributing part of your profit to Social Security and Medicare, what the government considers to be your fair share contribution at 15.3% of whatever your company's profit is. Well, 15.3%, if that's just for your self-employment tax, then you add on 20% federal, let's say, and another 8% state. You're thinking, wow, I'm paying 30, 40% of my income back in some sort of tax. What's the point of working so hard, right? Well, there is light at the end of the tunnel there. Obviously, if you're in a power position making 500, 600, 700 grand plus, yes, you might be considered a 1%er at that point in the highest income bracket. But let's face it, at the end of the day, even after tax, you're going to be sitting on a lot more cash in your bank account than an individual making 50 to 100 grand. So it's always better to make more, even if the tax does increase. Let your tax advisors help you shelter that income in very specific and certain ways in a safe way. You know, obviously, there's definitely a stepping over the line side in the tax industry where you don't want to get nailed for abusing the tax code. But through proper planning and proper structuring, you can effectively drop your tax rate as low as, let's say, 15%, even though based on the income that you've made, you should technically be in the 32, 35, or 37% brackets. So there are great ways to shelter income. And like what was mentioned earlier, it's not so much about how you make, it's about how much you get to keep. And it's not about how much you spend either. It's about how much you get to keep out of profit. So you can kind of look at it from both ways. I always tell clients that when you talk to a tax advisor, it is one, to file tax returns normally, and two, it's to put a plan in place for you as a business owner, a plan to retain wealth. Taxpayers get hung up on paying less tax, right? We all think, well, I go to a tax advisor because he's going to get me to pay less tax. I actually look at it as not only saving you tax, but more importantly, helping you retain wealth. Because if I can save you $10,000 of tax, in your eyes, you're paying $10,000 less in tax. But in my eyes, you actually got to keep $10,000 of your hard-earned revenue that you've made over the past 365 days. So I look at it as tax planning as wealth retention planning. And if you can think of tax strategizing and tax planning as a wealth retention business model, I think that you'd probably be a lot more excited to talk to your tax advisor. So keep that in mind. Failing to plan is ultimately planning to fail. You're not going to enjoy the results if you don't put a plan in place. Right now, it's January 26th. We're at the beginning of 2022. It's too late to incorporate you for 2021, unfortunately. But we are at the beginning of a very unique year, hopefully the tail end last year of this pandemic. And if you are hitting certain strides in your business, incorporating might actually be right for you. But I want to make sure before I move on to the nitty-gritty details of incorporating that you all understand that incorporating is not right for everyone. Okay. Just because I am presenting to you a power of incorporating PowerPoint presentation, it doesn't mean that you should just leave this webinar and go start an incorporated entity because of all of the benefits I'm about to lay out for you. Have this conversation with your tax advisor and make sure that it is the right time for you specifically to incorporate, not because your coworker or your neighbor or a family member incorporated themselves, but because it's the right time for you. Because even though it might save you a lot of money, there are additional costs to file as an incorporated entity, especially and specifically here in the wonderful state of California. Other states might have lower incorporating fees, which we'll talk about in the upcoming slides, but you might achieve other benefits by incorporating elsewhere, probably not so much of a tax savings benefit. But like I said, getting a little bit ahead of myself, we'll get into that shortly. The LLC, the C Corp, and the S Corporation are the three most common entities. There's LLPs and LPs, which are normally for legal or finance firms. So for you as real estate investors, I think that and real estate professionals, I think you're really going to hone in on either the LLC, the C Corp, or the S Corporation. Which one is right for you? We'll determine today based on a couple very key factors, okay? So as far as incorporating, if it's right for you, one, we got to figure out why most people incorporate from the get-go. Right out the gate, what benefit is there for you? What certain levels of income or strides in income or revenue generated do you need to hit in order for the incorporated entity to save you more than it's costing you, right? Because you want to know, okay, well, if it's going to cost me X amount, is it going to save me more than what it's costing me? So financially speaking, it doesn't make sense for you. So I always ask three very important questions in every, what I call the interview process with new clients. And all of our senior preparers are well-versed in this as well. So it's not just me. Is incorporating right for you? Well, we have to determine whether or not you have personal assets that need protection or separation from any business liabilities that you may carry as a self-employed individual. For instance, if you individually own a business under your primary social security number and you have a real estate portfolio, which is all registered under your primary social security number, and let's say that you have other personal ventures that you deal with, you're charitable, so you travel for Doctors Without Borders or Habitat for Humanity. So you've got a lot going on, right? If you have real estate portfolio investments and you have a small business and they're all registered under your primary social security number, technically those businesses and those assets would be all subject or potentially subject to any potential litigation that you are involved in. Meaning that if everything is tied to your primary social security number and somebody sues you personally, they're not suing your name, they're suing your social security number and everything that's attached to it. And so the number one benefit of incorporating is not going to be the tax savings. The number one benefit of incorporating as any entity is the asset separation benefit, meaning that you are separating your real estate business from personal liabilities. You're separating your rental properties from personal liabilities. You're separating your real estate self-employed business from all of your real estate investments. So asset separation equals asset protection and vice versa. So the first question right out the gate that I have for clients in this interview is, do you own any personal assets? Do you own your own home? Do you own rental investments? Do you have art collections? Do you have a large inheritance that has already come in or potentially coming in over the next couple of years? Because we want to make sure that we are incorporating and getting the greatest asset protection benefit under the asset separation and incorporation kind of plan. Number two question, so once we determine whether or not you own personal assets, number two would be, what is your potential or consistent net revenue going to be under your self-employed business? The reason why this is very key from a tax perspective is we want to make sure that if we incorporate your business, is it going to save you more in tax than what it's costing you? And this is a question I get almost on a daily basis. What is that golden ticket number? What net revenue do I need to show in order for incorporating to save me more than it costs me? And after 17 years of working in the industry, I've realized, well, if people incorporate for different reasons, but if you are looking solely to incorporate for a tax benefit, your profit, so meaning your gross commissions minus all of your expenses, your net profit has to be at or above $45,000 to $50,000 consistently per year. Now, what does consistently mean in this situation? Consistency means 2 years or more running. One, if you're just getting into the real estate industry or just getting into the real estate game and you're hitting the ground running and you're closing deals left and right, it doesn't necessarily mean that that business profit is going to be there next year. And I'm not saying it won't be. I would bet on you rather than betting against you, obviously. But you just don't know the consistency in your net revenue just yet. So I wouldn't suggest incorporating right out the gate for your first year of selling property unless you were already hitting strides in the hundreds of thousands of dollars in net profit, because then obviously you've already built a pipeline for yourself. It's just a matter of, keeping a few of those clients and the referrals in the pipeline, and then you're going to be hitting those strides of net revenue, no problem in future years. But if you're just getting into the industry and you're hitting the 20, 30, 40 grand marker gross, I would suggest pushing off incorporating, at least from a tax savings perspective, because it's not going to save you more than it costs you. Sure, by incorporating, you'd have great asset protection, but as far as costs, it would end up saving you less than what it would cost you. Number three question, aside from, so we had what do you own personally? What is the consistency in your net revenue? And number three would be, what kind of risk and liability do you operate out within your industry? Normally, after question one and question two are answered, I can determine whether or not incorporating is right for you. But let's say that you don't own personal assets. Let's say that your net revenue just isn't there. So we go to question three. Well, what kind of risk and liability do you operate at? Well, imagine if you are thinking of starting a skydiving instructing business. I always use this example because skydiving instructing businesses probably run some of the higher risks in those industries, because you're jumping out of a plane with somebody's life attached to your chest, right? A human being attached to your chest. So those individuals, whether question one and question two are answered yes, question three might warrant incorporating that kind of business solely from an asset protection standpoint and future asset protection standpoints, even if the profit isn't there yet. So with real estate professionals, it usually lands in the first two questions. One, do you own personal assets? More importantly, based on your current net revenue or consistency in net revenue, is it going to save you more than it costs you? So once we go through that interview process, we check off all the boxes with those three questions. Then we move on to what the most important parts of running a business and operating a business are. Number one, the number one question after you start the incorporation, you start having money deposited into the company account is, hey, Tony, how do I get that money out of the account? Do I have to pay myself? Do I just cut myself a check or do I wire transfer money from the business account to my personal account? It really all depends. And I don't normally like saying that phrase in the tax industry because I know people don't like hearing it, but it truly all depends on, one, how much net revenue you have, and number two, what you are utilizing that money for. I'll be real transparent with you all that about 90% of your life technically should be run through your business. Now, I'm not saying your personal expenses, because personal is personal, business is business, but there is a pretty short list of what you should never run through your business. And the rest of your expenses, there's some flexibility, like cell phone and online charges, those things. Of course, you're going to use them a majority of the time for business. But there are a short list of things that you never want to run through a corporation or an LLC because they are truly personal expenses. Number one, your personal groceries. The turkey, the lettuce, the milk that you spend your money on, that would never be through business unless you were buying a turkey platter with cheeses and meats and things like that to bring to an office meeting so that people could make sandwiches. Obviously, there's kind of one-off cases. Number two, gym memberships. I don't even recall a professional athlete of mine. I do several professional athlete returns, and even they can't write off gym memberships. Gym memberships are considered to be luxury expenses. So you have to be very careful with your gym memberships. So that's number two. Number three would be anything that you really can't take a step back and look at and say, is this an ordinary, necessary, and legitimate business cost? Obviously, I go to Starbucks and Coffee Bean a lot on my way to work, and I grab some coffee and maybe some bagels and things for the office. So even though I'm going there and buying coffee for myself, if I'm buying a box of donuts or bagels for the office, that would be a write-off for my business because I'm buying it for my employees or for my contractors, right? Whereas if it's just me going into Starbucks to grab a cup of coffee on a Sunday morning, and then I'm heading back home with my son or my daughter or my family, I'm probably not going to write that off because there was no business done. So there still needs to be separation of personal expenses and business expenses. Personal groceries is one, gym memberships two. Number three would be that example, ordinary, necessary, and legitimate. But then I also want to mention as part of kind of the gym memberships, country club memberships. These are things that get people audited so quickly. And I'm not assuming that everybody has a country club membership, but some people here in LA do, especially people who live in the Valley and maybe up in the Glendale kind of ravine up here between La Cañada, La Crescenta, and Glendale. There are a lot of country clubs here in LA. So those unfortunately will not be tax deductible. I don't really care how much of an argument we have as to how much business is done at this country club. It will fail every time under audit because it is considered to be a luxury expense. So be very, very careful about, how your preparer in the past has written this off. It is not the Wild West. It's not where you just throw everything on the return, and if it's ever questioned, the government just removes it and slaps you on the wrist and says, don't do it again. That's not how the IRS works. They will slap you on the hand and tell you not to do it again, but then they'll slap you with interest and penalties where all of a sudden you're basically flushing money down the federal government toilet. Pardon my language here, but that's how I view it. Interest and penalties, it's just wasting your own money. So let's make sure that we position you in the correct ways to reduce liability overall in the correct and safe and legitimate ways. And there are very, very creative and legitimate ways to do this, which we're going to talk about all today. So how do you move money out of the business to you personally? Once again, if you're running a majority of your expenses through the business, then very few things should be paid out of the personal account, but I get it. You want to make sure that you have money to pay for maybe your mortgage payment, property taxes, maybe homeowner's insurance, which are all personal expenses as well, not businesses, unless the business owns the property, right? So if you own all of those things individually, you want to move money over to your personal account to pay for those personal expenses. And your first thought is, well, I need to put myself on payroll. I need to start issuing myself a salary. And right out the gate, especially if you are a new business, you don't want to put yourself on a salary just yet. Because one of the magic parts of an incorporated entity like the S Corporation, which we're going to talk about mostly today, LLCs and C Corporations we'll talk about briefly, but we're going to focus on the S Corporation because that's really the one that ends up saving people tax. One of the magic parts of an S Corporation is the ability to control the amount of salary that you pay yourself as an owner and employee of your own business. Okay. And it's all about following the reasonable salary requirement, meaning that if you have, let's say, $100,000 coming in through your corporation as profit, you do not have to pay yourself the full $100,000 in profit as a salary. That would be silly because then what's the point of having the corporation? You've wiped out your profit. You've paid it all to yourself as a salary. And now that full $100,000 is subject to Social Security, Medicare, state disability, unemployment insurance, employment training tax, federal and state income tax. All of a sudden, there's no benefit to the corporation whatsoever. In the Internal Revenue Code, a built-in part in the IRC, it states that as a corporation owner and employee, you can pay yourself something called a reasonable salary payout, which in the real estate professional industry can be as low as 35 to 40% of company net profit. Now, why would you want to pay yourself such a small amount? Well, number one, you want to keep most of your cash in the company account because that's where a majority of your expenses are, but you also want to show reasonable compensation to yourself as a business owner for lending purposes, just to control the ability to make financial moves on the personal side outside of the corporation, which consistency and payroll is key there. And so you want to make sure that you hit these figures accurately. And that's why I'd say, no joke, 98 to 99% of my real estate professional clients go the first, second, and third quarter of each calendar year, January through essentially September 15th, without issuing any salary to themselves. Sure, they can own or draw money out of the business, but do not issue it to them or to yourself as a salary. You just merely wire transfer money from the company account to your personal account. This is under an S corporation, and that is considered to be an owner draw. You are tapping into the equity that you've built within your business, part of the profit throughout the year. In the fourth quarter, once we have year-to-date income, year-to-date expenses, we can dial in a more defined net income or net profit figure. And that is when we issue you an exact calculated amount of 35 to 40% of the net profit as a W-2. And this allows you to avoid certain types of tax on the company's flow through profit. So we have to make sure that we're playing this game. I'm going to dial in a calculation for you in a couple slides. It's all going to make sense. I promise you. I know that eyes must be rolling back in the back of your head. It happens in every seminar, but I'm going to come full circle with all of this. Do not worry. Okay. So as far as the calculation is concerned, if I'm bringing in 100 grand into this business, and now I have a corporation in place, an S corporation, for instance, and this 100 grand is after all of your expenses have already been taken into account. Remember, you have to pay yourself a reasonable salary, right? Which can be as low as 35 to 40% of your net revenue. So let's say on the high end, it's 40%. $100,000, 40% of 100K gives you a $40,000 W-2, which now that you've paid yourself an employee, aren't employees a write-off for the business? Absolutely. So $100,000 minus your $40,000 salary leaves the company with a leftover what's called flow-through profit amount of $60,000. So you've got a $40,000 W-2, you've got a $60,000 flow-through profit figure. Now, why is it so important to separate that 100 grand into these two figures? Why is it so important to have a W-2 and this flow-through profit? Well, what you've just done as an S corporation is made $40,000 subject to federal tax, state income tax, and Social Security and Medicare tax, because it's payroll tax on the 40 grand. And on $60,000 of leftover profit in the scenario, sure, you pay federal and state income tax on it, but what you've completely avoided, remember, tax avoidance is not illegal, tax evasion is. So let's always try to not evade taxes, let's try to properly avoid paying tax. So on $60,000 of your profit, you've completely avoided paying 15.3% of Social Security and Medicare tax. Now, how much does that overall map out to be tax savings wise? Well, let's break it down even further. Let's assume that your average federal tax rate is about 25% in this bracket. Let's say it's 9.3%, and then that nasty self-employment tax is 15.3%. If you chose not to incorporate yourself and your business profit was 100 grand as a sole proprietor or even an LLC, remember what I said earlier, LLCs save you nothing in income tax. So LLCs and sole proprietors pay the exact same tax rates. So in the left-hand column, sole proprietor LLC, 25% of 100 grand, 25 grand, 9.3% and 9,300, self-employment tax, 15,300 bucks. At this point, you're thinking, wow, I'm paying all of this money back in income tax. Why am I working so hard, right? Well, remember that you're always going to work harder to make more money because you'll always have more left in your bank account at the end of the day. But if you are hitting stride at about 100 grand in net profit, and you flip yourself to a subchapter S corporation and follow the reasonable salary payout game or ruling, then you can pay yourself a salary. And look what happens to federal and state income tax. That does not change, because no matter how you split 100 grand in profit, when you add those numbers back up, it's still $100,000. But now that you've got a $40,000 W-2 and $60,000 of profit under the business because you wrote yourself off, you wrote your salary off, now only $40,000 is subject to self-employment tax, now known as payroll tax, and your overall self-employment tax drops from $15,300 down to $6,120. And you're not really even playing the games that corporate America plays. You're literally just following the rules, paying yourself a reasonable salary. Overall, that drops your Social Security and Medicare tax by upwards of $9,180 just by filing as an S corporation versus a sole proprietor LLC in this specific example. Now, I mentioned earlier that the net income figure, that kind of golden ticket number, would be at about 45 to 50 grand. So I've given you a calculation at the bottom of the screen here. At $50,000 under an S corporation, you're yielding an overall tax savings of about $4,590. So your next question is, okay, well, that all sounds great, but how much does a corporation filing cost me? Well, once again, if you're pulling your self-employed business off of your individual tax return, filing an actual corporation tax return now, the corporation has its own filing fees. You now have to issue payroll to yourself. There's California Franchise Tax Board filing fees. So industry average to operate a corporation, filing wise, payroll wise, tax preparation fee wise, can range anywhere from about $1,500 a year up to about $2,500 a year. If you're going above and beyond that, you're probably paying for other services as well, and that could kind of tip you over that $2,500 point. But between $1,500 and $2,500, well, at 50 grand, it's saving you $4,600 in tax. So it's still saving you almost double what it's costing you. That's where we calculated that 45 to 50 grand number. We have to make sure that not only are we getting great asset protection benefit, but we are also receiving the income tax savings benefit where it saves you more than it costs you. Hopefully this makes sense. This is probably the best breakdown that I can give somebody, and just using figures and not trying to confuse anybody. But at about 45 to 50 grand, at least entertain the idea of utilizing an incorporated entity to reduce tax and give you greater asset protection to separate your business from all of your personal liabilities. Now, on top of that benefit, something that was introduced under the 2018 tax reform bill was something called the QBI deduction. QBI stands for, it's not another variant of COVID. Okay. So, I actually laugh at that because I think that's funny. QBI doesn't stand for another variant of COVID, but it stands for Qualified Business Income Deduction. And essentially, in order to receive this benefit, you have to make sure that your taxable income is below a certain threshold by the end of the calendar year. So it's really important for you to sit down with your tax advisor in October, November, and December and map out creative ways to drop your taxable income below one of these two qualifying thresholds. For married filing joint, and these thresholds are going to change for 2022 with inflation, but if you are married filing joint, you're going to go to the left hand. Hopefully you're looking at the same screen that I'm looking at, but you're going to go to the blue column. Okay, so if you're married filing joint, go to the blue, yes. If you are single or head of household or even married filing separate, you're going to go to the red column. The first threshold that you need to be aware of married filing joint is at about $327,000, $326,600. If you are single, head of household, or married filing separate, the first threshold drops to $163,000. This is your taxable income, not your gross, so not before expenses. This is literally after you've deducted everything under the sun, played the reasonable salary ruling game, deducted your mortgage interest, your property taxes, your charitable contributions. After all of those deductions, that calculates your taxable income. And if your taxable income married filing joint is below $326,600, and if your taxable income is below $163,000 for all other filing statuses, the first 20% of your company's profit is tax-free, meaning it pays no federal income tax. So let me map this out for you in numbers. Let's say that you are married filing joint, both you and your spouse are married filing joint. Married filing joint. Both you and your spouse are self-employed. And let's say that both of you are making $150,000 in net profit. So let's add those up. You're at $300,000 of taxable income. Let's just assume this is after expenses. So you have $300,000 below the $326,600 threshold. So because you're both self-employed and your profit after expenses is 300 grand, you do qualify for QBI because you're under the $326,600 threshold. And that makes 20% of $300,000 tax-free. What's 20% of 300 grand? That's $60,000. It's not 6,000, not 600, $60,000 of your income that you pay zero federal income tax on. Okay. If you're single, head of household, married filing separate, and you're at $100,000 in net taxable income, that's $20,000 of tax-free income. Now, just because you're above one of these two thresholds doesn't mean that you don't qualify for the benefit. But like other parts of the Internal Revenue Code, the federal government will slowly start to phase you out from receiving this benefit. And the full phase out threshold for married filing joint is $426,600. Married filing separate, single and head of household is $213,300. So once again, don't you think it would be really important for you to sit down with your tax advisor and figure out creative ways to keep yourselves below these income tax brackets, maybe by going out and purchasing a new vehicle for your business, if you're already shopping for a new vehicle, or if you have a rental investment, you've been thinking about making some improvements to it, building an ADU in the backyard, adding solar panels, things like that, things that are great overall tax write-offs for you to keep you below one of these two thresholds, and boom, qualifying for 20% of your business income to being received tax-free. I think this is probably one of the greatest tools built into the Internal Revenue Code, but it's not a tool that everyone can use. It's not a benefit that everyone will receive. So you have to plan ahead. Failing to plan is ultimately planning to fail. You have to plan ahead to keep yourself below one of those two thresholds. So just keep that in mind. Another great way to help reduce self-employed income is to set yourself up with an in-home office deduction. Now, I know that probably most of you have already had conversations with your tax advisors about in-home offices. Some tax advisors might suggest not to even take it because it runs a very high risk of audit. First off, if you're ever utilizing a tax advisor that steers you away from taking a legitimate write-off because they fear it getting audited, you are working with the wrong tax advisors. There's a whole 3-page part of the Internal Revenue Code that states that in-home office deductions are ordinary, necessary, and legitimate. Even though you might have an office, like I'm sitting here in my office in Glendale, I have an office, a beautiful office. My wife has a beautiful office in our home that we set up during the pandemic. We even had offices prior to the pandemic inside of our house. Now, I can't use that office expense to offset my W-2 income, but on my self-employed business side of things, sure, I can actually take portions of my home and rent them out to my corporation. So my corporation can pay me rent, further reducing my company income, claiming the rental income on my personal return, but then offsetting that rental income with parts of my mortgage interest write-off, property taxes, homeowners insurance, a portion of my utility bills, the office furniture that I purchase, computer equipment that I purchase. So in theory, if I pay myself $15,000 in rent to rent out this 12 by 12 room inside of my house, and I claim the 12 or 15 grand in rental income on my individual return, and I can wipe it out with expenses that normally wouldn't be tax deductible for me because they were mostly personal expenses, all of a sudden I've made 12 to 15 grand disappear completely into thin air legitimately. I know that the disappearing word kind of throws people through a loop because they're like, there's got to be something wrong there. But there is a portion of the Internal Revenue Code that allows corporations to rent out office space inside of the primary shareholders' homes. And this is a very unique part of the Internal Revenue Code. A lot of preparers don't know about it. And if they do, good on them. But this is all part of corporate tax code that allows shareholders to maneuver the money back and forth in very creative ways. Now, not only are you making money disappear legitimately because it's a legitimate overall write-off, but what happens when you've created this new deduction for your business? It has reduced your company net profit, which requires you to pay out less as a reasonable salary, which in turn not only saves you federal and state tax on the 15 grand, but it also saves you Social Security and Medicare tax on not having to pay yourself more of a reasonable salary. So we're not talking about hundreds of dollars in tax savings here. We're talking about thousands and thousands, if not tens of thousands of dollars in overall tax savings benefit. These are conversations that you need to have with your tax advisor. It's not something that you should try to navigate on your own, okay? Some of you might be thinking, well, Tony, this is all great and I'm going to implement all of this, but how much can I push forward with this? You know, what else can I do to even further reduce this? Can I incorporate in Nevada? Can I incorporate in Delaware and Wisconsin? I saw somebody is logged in from Georgia. Can I incorporate in Georgia? Sure, you can incorporate in other states, but California and New York, okay? Wonderful California, wonderful New York. We are very unique states. I love living here in California. I don't plan on leaving anytime soon. I do understand that we pay a premium to live here in the state of California. We are the highest tax state in the US. New York is now second to California. We have some of the most expensive cities in the United States here in the state of California. LA, I believe, surpassed San Francisco per capita. Not San Francisco is much smaller than LA is, but per capita, I believe LA is now more expensive than San Francisco. I heard that last year, so maybe that's not true anymore, but I believe we're very close. So California and New York, very unique states from a state revenue code standpoint. California does not follow very much a federal tax code. So California, in its unique way, taxes its residents on their worldwide income. And so if you incorporate elsewhere, sure, you might get great asset protection under that state, whatever state you incorporate, under their state legal laws and legal codes. But as far as avoiding California state income tax and California filing fees, you're not avoiding anything. because California follows its residents to the states that they incorporate in. And now you have to file not only in that state, in Georgia or in Nevada or in Texas, you also have to file the corporation as for under foreign jurisdiction here in the state of California and still pay California's filing fees. So once again, you can go elsewhere for greater asset protection, but not to avoid income tax. In order for you to avoid filing fees and income tax, you would physically have to move to those states, which I've seen a lot of my clients do. I called it the mass exodus. I'm sure that a couple media outlets have called it the same thing. I had probably, and I'm not even exaggerating, probably close to between 10 and 15% of my clients move out of the state of California. We're doing everything digitally with them. They were done with the tax rates, you know, whether it was politically driven or whatever, it doesn't matter. I mean, at the end of the day, when you make money here in the state of California, California now has the highest tax rate of close to 13% at some of the highest income brackets. That's only the income tax rate. That's not including our sales tax, our use tax, our city tax, our, you know, all of these other taxes that we pay. So our property taxes. So if I already didn't mention that, but when you add it all up, California is a big chunk of your overall liability, not comparable to federal at certain levels of income, but it is definitely a major tax savings for higher income earners. And when I say higher income, I'm not talking about $1 million earners. I'm talking about people making 300-400 grand. I mean, you're saving close to 10% tax if you're making 350 grand, right? What's 10% of 350,000? $35,000 in tax you save simply by living in a different state that maybe doesn't have state income tax. So incorporating elsewhere, great for asset protection, not for tax savings benefit. Okay. Let's talk really quickly because I know I'm getting to the end of the time here and I want to make sure we get to Q&A. What's the difference between the LLC or the incorporated entity, the trust, and the insurance policy? This is a commonly asked question and kind of confusing for some clients because they think, well, I have a trust, I don't need an LLC or a corporation. Oh, I have an insurance policy, I don't need a trust or an LLC or a corporation. Understand that all three of these things you see on the screen provide a completely separate benefit to you as a business owner. Number one thing you should have is the insurance policy. Everybody should have some type of insurance. We have health insurance in case we get sick. We have car insurance in case we're in a car wreck. We have malpractice insurance, liability insurance for our businesses in case we're ever sued. So insurance by far is the most important thing for us to have. It is there and in place to pay out settlements in case an unforeseen event happens. An insurance policy does not separate business and personal assets though. And let's face it, how many people probably in today's webinar, if we could all raise our hands, you know, in a live seminar, how many people have heard of people being dragged through the mud by their insurance companies and eventually not getting the payout and having to come out of pocket to pay that settlement? I know of a lot of cases. So insurance is absolutely the most important thing to have, and it does have a cash payout value, whereas it does not separate business and personal assets. That's where the incorporated entity comes into play. So the correct structure here is to have the insurance policy under your incorporated entity. The incorporated entity as an LLC holds your rental property, or the S corporation holds your real estate business. So the insurance policy under the entity, and then the owner of your entity is not you personally, it should be your living trust. Now, the trust does not protect you from potential litigation. The trust protects you from probate here in the wonderful state of California or any other state that you file in. So yeah, I call it the golden pyramid, essentially, right? You have the insurance policy and the incorporated entity on the bottom, and then at the top, you have the trust. And that way you are protected while you're alive and you are protected in death, okay? So is it important for all of you to have this structure? No, it's not. And that's why you need to sit down and have this conversation with not only your tax advisor, but also with a trust and estate attorney to make sure that if you have legacy, if you have next of kin, if you have children, or if you have charities that you want to leave your wealth to, you need to make sure that you set up the right kind of trust so that the state of California doesn't seize your assets in death and get their sticky fingers on it. Because probate is a nightmare. I can tell you that right now. Some of you may deal with probate sales, probate in general, complete nightmare. And the only way to properly avoid probate is by having the correct trust type entities set up. And also for potential litigation, the incorporated entity. And then in case, heaven forbid, anything happens, you have insurance as a payout windfall. Okay. So just keep all of that in mind. Now, changes to the 2022 tax code. There are a lot of changes on the horizon. Nothing has been set in stone as of today. We were expecting the 22 code to be available probably 3 or 4 months ago. we are still waiting to hear what 2022 has to bring into fruition. I know a lot of people that I've talked to have said that they've heard, not only read in some articles, I have yet to see it in internal revenue code, because I always wait. I don't really care what's written online and what journals are written and what professionals are talking about them, because I know that when it's set in stone in the IRC, the Internal Revenue Code, that's what we follow, right? Because there's a lot of speculation about these changes. What I've heard is that the 1031 exchange conversation has been tabled, meaning that they are not going to be changing the 1031 exchange. That is what I've heard. It is not what is set in stone in the new Internal Revenue Code, though. We don't have that just yet. So have your head on a swivel. I've had my head, it's almost like I could spin my head 360 degrees, because it seems like things are changing by the day. There's no bipartisan agreement on any level of government these days. So we're just waiting to hear on what the final code is so we can advise our clients moving forward. I do know for a fact the brackets will change. They always do with inflation and also economic increase, economic expansion, economic shrinking. So the brackets will change. Capital gain rates more likely than not will change, but not for individuals making under $500,000 or $1 million. Okay, so if you're single and your taxable income is under 500 grand, you're good. If you're married filing joint, your taxable income is under $1 million, you're good. Nothing will really change for you. But if you have a big windfall sale where you sell a rental property or sell shares of a corporation, let's say you bought Moderna stock and you made $1 million on Moderna stock. If that capital gain bumps you as a single individual above 500,000, or if it bumps you as a married filing joint couple over $1 million, every dollar above those two thresholds in capital gain will be subject to not 15 or 20% long-term capital gain. Your long-term capital gain rate will jump to 39.6%. Okay, so there are a lot of changes on the capital gain part of the Internal Revenue Code. So we're still waiting to hear final verdict on that. If they do in fact change 1031 exchanges, that will also impact the capital gain side of things. And you can only imagine what would happen if they did actually change that, because the exchange industry makes up for 16% of the United States real estate transactions. It employs over 600,000 employees here in the US, and it generates over $40 billion in revenue for the US government. So I don't understand why they would be changing anything under the Internal Revenue Code dealing with 1031s, because it is a big money generator for the federal government and a true stimulator of the US economy. But we'll have to wait and see. Some of these parts of the Internal Revenue Code have been around for over 100 years. So now they're trying to change parts of the code that have been around for a very long time. Some changes might be good, some changes might not be. I know they're talking about changing the SALT deduction from $10,000 up to $80,000. Really excited about that for a number of reasons. But once again, there will be phase in and phase out thresholds. And that is all the small writing. That's the small font writing in the Internal Revenue Code that we just don't have yet. But I would be more than happy to come back as soon as we have that Internal Revenue Code in our hands. I'll have a whole other PowerPoint presentation for you all, and I'll be back with all of those updates. Okay. I'm sure that we have Q&A. I know that I probably went a little bit over time, but there was a lot of information there. If you have to, if you have to move on, text Robert Hall to 72,000 to get the free consultation, and that is the best way to connect with us. We'll get you set up with a scheduled appointment, review 2 years of tax returns. We'll check for any possible audit triggers on the already filed returns with your previous preparers. And then we'll also let you know about our upcoming free educational seminars. All of our education here at Robert Hall is free. And that's something I feel very proud to say. We've been doing educational webinars and seminars for the past, I think, 12 years. We do over 140, 150 events per year. I'm the only public speaker. So if you've heard Robert Hall's and Associates name before in a webinar or seminar, it's usually me being the speaker. So I look forward to speaking with all of you soon. And if we have time for Q&A, we can open it up for Q&A.
Okay, well, thank you, Tony. So we do have a few questions, and most of it came from SJ, by the way. One question was regarding, okay. So here's a question regarding broker fees. So, most real estate agents work under a broker and they get charged broker fees. So he or she wants to know, where would you record that on your tax return?
Broker fees. So essentially it would either be under, I mean, you could actually do a couple things with that, but I would actually itemize it under, because I'm assuming that either you're filing a Schedule C or an actual 1120S corporation return.
1120S is a
1120S corporation return. So under the S corporation return, you could do it a couple ways. You could put it under legal and professional fees. You could put it under office fees. You could put it under brokerage fees, under itemized deductions. we're not talking, just for clarification, we're not talking about referral fees, right? We're talking about broker fees, like fees that you
Broker
pay to your
fees.
broker. Okay. So those would all be itemized under either brokerage fees or just general office fees, or even under legal and professional. They would be dollar for dollar tax deductible.
Okay. And another question, as you know, during the pandemic, a lot of realtors end up working from home, or some do have a home office. And the question is, should you, well, I'll let you answer it. Should you depreciate your home? Well, okay. Would it be a smart move to depreciate your home building for $100,000 basis under the home office expense?
So there are a couple key parts to depreciating a property. One, when you have an in-home office, you don't take the value of the total building, right? You have to take the allocated square footage in the home and depreciate that percent of the total square footage. Some of you might be thinking, well, when I sell the home, won't that trigger a tax requirement? Won't that limit my Section 121 exclusion? What will that do from a tax perspective? Well, remember that we're not talking about tens of thousands of dollars in depreciation. I mean, sure, if you rented out your whole home, then the whole building would be a depreciable expense. But we're talking about a very small deduction, really only to offset a very small amount of rent that you're collecting from your business, right? So in theory, you'd take the total building value. So let's call your home $1 million value. Let's say you bought it for $1 million. Let's say that it's 65% building, 35% land. So $650,000 of the $1 million is the value of the building. Let's say that 15% of your home is the office space. So 15% times 650,000, you've got $97,500 of the building that is a depreciable amount. That 97.5 has to be divided over 27 and a half years. That gives you a depreciation write-off each year of $3,545. Now, if you're thinking about selling your primary residence in like 2 years, I probably wouldn't even set up the in-home office with depreciation as a deduction. I mean, sure, it's a great write-off, but if you're planning on selling it in 2 years, yeah, it's probably not even worth it because you're going to get this massive exclusion kind of windfall on the back end. But if you're never planning on selling your home, that $3,500 write-off per year over a 27 and a half year period gives you a massive deduction to offset self-employed income. Remember that that deduction isn't only saving the federal and state income tax, it's also reducing 15.3% of Social Security and Medicare tax as well. So that $3,500 plus a percentage of your mortgage interest, plus a percentage of your property taxes, a percentage of your utilities, a percentage of your homeowner's insurance, a percentage of your HOA dues, a percentage of your home improvements to the office space, all of a sudden you're utilizing all of the expenses to offset 15, maybe 20 grand of rental income that you're collecting legitimately. Okay. So the question was, do you depreciate? I think that was the question, because I don't know, there's a ton of things in the chat box. But yes, technically the way the Internal Revenue Code writes depreciation is when depreciation is allowable, it must be taken. Okay. So I personally 100% would take this. And if you are selling your primary residence down the road, remember, if you're married filing joint, you get a $500,000 exclusion. Now, if you've owned the home for 30, 40 years, you're probably well above that $500,000 exclusion anyway. So it's all about adding expenses to the basis of that property. But if you bought the home in the past, I don't know, 5, 10 years, I would still assume that you might be under, especially with all of the improvements you made to the property, that when you sell it, you'll be under the exclusion amount, which will clear out any depreciation recapture tax that you're fearing having to pay upon sale. So great question, but it really all depends. And you should have more of a detailed breakdown with your tax advisor and kind of map that out to make sure that it doesn't cause you some sort of headache tax-wise on the back end. I'll tell you right now, in 17 years, I've never seen this become a headache for somebody. Full transparency. I think this is a great way to shelter taxable income, keep more money in your pocket.
Well, thank you, Tony. I know we have more questions, but it looks like the question is a little bit more detailed. So I really suggest you all text the word Robert Hall to the number 7200 so that you guys could take advantage of getting a free consultation and get some of those questions answered. Because so thank you. And thank you, Tony, again, for coming out and sharing and educating us on the power of ink. And at this time, I can turn it over to our president-elect, Cindy. Oh, and one thing too, by the way, to answer the question, we will be sending out a recording of this event. So you will check your email, you'll be getting a recording of this event and as Tony's contact information and Robert Hall's contact information, because they are a nationwide company.
Thank you again.
Thank you so much.
Thank you very much, our president, media past president, and Tony, for that great presentation. As all of you that's here on Zoom from across the country, it's just like any other event we will be having. And of course, we want to get to know you. We want you to get to know other people that's on Zoom as well. As one of the #1 benefit of being a Women's Council of Realtors, or if you're here as a potential Women's Council of Realtors, remember to join our local network. The link is actually in the chat. We'll put it again here, so it's immediately on the bottom. And wanted to just mention that we look forward to getting to know you. So for the next few minutes, we're gonna break you up into breakout rooms, about 4 to 5 people each person. We're gonna ask you to please tell us your name, what area you're from. Tell us a little bit about if you're a realtor, tell us a little bit of the area that you're from and why people should move there. In addition, please also, if you know, please also tell us the average price point. I already saw in the chat earlier, somebody is asking if we have a realtor from Sacramento area. I sense that there's going to be a referral sending out your way, but please do just spend a few minutes with us and tell us where you're from and why should we invest in your area or purchase in your area. So now give us one moment while we set up that room. Okay, so we'll see a little bit